Hello and welcome to Business Incorporated. I'm Laddie Williams. Coming up on the show today, UN adopts landmark framework to integrate natural capital in economic reporting. And Moody's places Ethiopia's B2 ratings on review for downgrade. And South Africa business confidence falls to 35 points in the first quarter of 2021. Let's get the show started with intraday market numbers, which were mostly positive on the African continent. Only the NSE declined marginally by 0.02%. Elsewhere, South Africa's GSE rose 0.1%, while the EGX 30 was higher by 5 basis points. Kenya closed positive on Wednesday. And markets in the Gulf region maintained Wednesday's trend, where sentiments were mixed. In the UAE, Dubai's index jumped 1.03%, while the Abu Dhabi index rose 0.54%. Elsewhere in the region, the Qatari index fell 0.46%, while Saudi Arabia's index lost 0.20%. And a couple of corporate earnings are out in the UK. Let's cross over to Juliana now for updates from London. Hello, Juliana. Great to have you. So I've had a number of corporate news out. You talked about John Lewis in the morning with INI. I also see WPP, the world's largest advertising group, Waitrose, Rolls-Royce. Are you also keeping an eye on these earnings?
Struggling to hear you, Laddie. Hopefully you finished and I'm not talking over you. But you're right, there is lots to pick from. There's a pick and mix of corporate data today. I suppose the big ones that the British business news are talking about are really the retailers. Firstly, we've got Morrisons, one of the big 4 retailers here in the UK. They actually posted a loss of £240 million in their final trading update of 2020. Most of this really is down to COVID-related costs. They have been paying for staff sicknesses. They've also made their stores more COVID friendly, and like a lot of big firms here in the UK, they decided to pay back business rates relief. A lot of them started doing that late last year, Morrisons being one of them, so they've attributed it to that cost. Notably, of course, because there is a transition to e-commerce, they have shown that online sales grew expeditiously, and they also partnered with Amazon. That's been helping. Another big story is about John Lewis. They're the giant retailer that I'm sure everybody knows. They have posted for the first time in their history losses to the tune of £517 million last year. This is a major story because they're really seen as one of the stalwarts on the British high streets. A few of them have gone, including Debenhams, which was a competitor. So people are watching John Lewis closely because this could show a sign as to whether the British high street can emerge and try and transform itself after lockdown. We're not expecting non-essential stores to open here in the UK until April the 12th at the earliest, which is 4 weeks' time. And because of these losses, their boss, Dame Sharon White, has told investors that not all stores will be opening because some high streets are no longer profitable. Fortunately for them, they've also got Waitrose under their belt. That's done really well because they fall under the essential retail stores. So they stayed open pretty much throughout the entirety of the past 12 months. And on its own, it's almost turning into £1 billion business.
Yeah, and on the data front, Office for National Statistics shows UK's consumer spending picked up at the start of the month, even though millions of workers are still furloughed due to the pandemic. What do you make of this data?
Yes, we've got this data. It shows a week up to the 4th of March. Britons are starting to spend again. This data is only looking at credit and debit card spending. Economists haven't really bedded down into these numbers. But I suppose if we look at the retail sales that we saw earlier this week, that did show a rise in retail spend. A lot of this really is down to going back to schools. Schools reopened for the first time in more than 2 months on Monday. So lots of parents going going out buying school uniform to make sure their children were going back with crisp white shirts. And also as well, Boris Johnson has opened the roadmap to lockdown and the ease of restrictions. So I think people are feeling pretty much joyful about that, and a lot of people are spending on clothing again. What we are going to expect, which is a big one I'm sure we're going to be talking about tomorrow, is GDP figures. This is the first look of GDP in 2020. In December, it rose to 1.2%. We're expecting it to fall by about 5.6% in January, so we'll have to keep our eyes on that.
All right, we'll watch that tomorrow. But bring us up to speed with intraday trading numbers.
Well, the FTSE started off in positive territory this morning, but it's pretty much slipped into the red at intraday. A lot of this is to do with yield, so banks are not doing great. They're dragging down the FTSE All-Share, which is down 0.02%. FTSE 100 also down by 0.14%. The domestic market, the FTSE 250, slightly up by 0.43%. In the currencies market, the pound is up against the US dollar by 0.19%, down against the euro, though, by 0.12%, and up against the Japanese yen at intraday by 0.21%, Laddie.
All right, Juliana, thank you so much for the update. Always great talking to you. Enjoy the rest of your day.
Thanks.
And European stocks were mostly higher this morning as markets react to positive momentum stateside following the final approval of President Joe Biden's $1.9 trillion COVID relief bill. Let's see what else is making the rounds at this time. And Chelsea joins us now. Hello, Chelsea. Great to have you. The European Central Bank will announce its latest policy decision in just a few minutes. What are the markets expecting?
Well, markets are expecting today a lot of talk and very little action from the European Central Bank. So the ECB isn't expected to change its monetary policy today, but investors are still going to be watching very closely for signals that the ECB is considering changes in the coming months. And the backdrop of today's meeting is that we've seen interest rates around the world start to rise over the past couple of weeks. This has really shaken global markets because low interest rates have really been the cornerstone of the monetary policy response to coronavirus. Low interest rates really allow governments, allow companies, allow people to keep borrowing and keep spending. And this is what a lot of central banks are trying to preserve to help economies recover from the coronavirus hit. So the ECB is under pressure to act to keep interest rates low here in Europe to prevent this from hampering the economic recovery. Today, investors are going to be watching very closely any comments from ECB head Christine Lagarde about whether the central bank is concerned about the rise in interest rates, whether they're concerned about inflation going higher, which is a concern we've seen it particularly spiking now after the passage of the stimulus bill in the United States. And that's really where markets are going to be focused on in terms of whether the ECB is committing to keeping rates low. That would be a good thing for stock investors.
And Apple says it will invest over €1 billion in Germany's southern state of Bavaria over the next 3 years. What are the plans here for the area?
Well, Apple really wants to build out its European chip design center. They want Munich to be the hub of their new silicon design laboratory. They plan to hire a couple hundred more people. This could be really the basis of their investment in things like semiconductors, 5G technology, wireless communication technology in Europe. For Apple, this is a major priority right now. Apple has long sourced most of its semiconductors from other companies like Qualcomm, but now they want to start building semiconductors themselves. That's been something they've put a lot of money into. Munich is really an area where they're hoping they'll see that technology be built out. But this is also for Europe. It really aligns with the goals of the European Union and Germany as well. The EU does want to see more development of these next wave technologies, semiconductors, 5G technology. They want Europe to be a hub of innovation like we see in Silicon Valley, or in parts of China. So this really, for both Apple and the EU, and Germany in particular, is a big move.
And it's all about the stimulus package today. U.S. Congress has approved President Joe Biden's $1.9 trillion coronavirus relief package. What do investors think the economic impact of this money will be?
Well, investors are saying this is a very big deal for the global economy and also for a lot of people in the United States. The stimulus package includes a lot of payments for people. It includes another round of $1,400 stimulus checks for a lot of Americans, as well as billions of dollars worth of aid to things like schools, as well as for vaccine development. This is expected to really lead to much higher growth in the U.S. The U.S. economy is now expected to grow by about 6% this year. That's the highest level since the early 1980s. That would, of course, help a lot of the U.S.'s trading partners, including Germany and the European Union. But really, where economists say the biggest impact of this bill is going to be is for low-income people in the United States. This bill expands things like child tax credits that would give some people thousands of dollars a year for each child they have, as well as things like rental assistance and food stamps. So this bill is expected to actually have child poverty within a year. So that would be a major accomplishment for the Biden administration.
All right, Chelsea, thank you for the update. I'll talk to you tomorrow. And away from Europe now, Asia-Pacific markets traded broadly higher today following a relatively strong finish on Wall Street overnight after U.S. lawmakers passed the $1.9 trillion coronavirus relief package. The Nikkei 225 in Japan rose 0.6%, while the Topix index added 0.27% to 1,924 index points. In South Korea, the Kospi rose 1.88%, buoyed by tech names, while Hong Kong's Hang Seng index added 1.47% in later afternoon trade. Chinese mainland shares also rose after struggling in recent sessions as authorities in Beijing set a relatively low GDP target and signaled a shift away from measures designed to keep the economy afloat. The Shanghai Composite rose 2.36%, while the Shenzhen component added 2.23%. Australian shares retraced earlier losses as the benchmark ASX 200 finished flat. And U.S. stock futures rose in early morning trade after the market's blue chip average set another record high during the regular session. Futures contracts for the Dow Jones Industrial Average added 142 points. Those for the S&P 500 climbed 0.71% higher, while NASDAQ 100 futures jumped 1.72%. The move in futures came after the Dow jumped 464 points to a record closing high on Wednesday. And in a move that may reshape decision and policymaking towards sustainable development, the United Nations has adopted a new framework that includes the contributions of nature when measuring economic prosperity and human well-being. The new framework, tagged the System of Environmental Economic Accounting, Ecosystem Accounting, was adopted by the UN Statistical Commission and marks a major step forward that goes beyond the commonly used statistics of gross domestic products that has dominated economic reporting since the end of the World War II. Experts emphasize that while a statistic such as GDP does a good job of showing the value of goods and services exchanged in markets, does not reflect the dependency of the economy on nature, nor its impact on nature, such as the deterioration of water quality or the loss of a forest. And Moody's Investors Service has placed the government of Ethiopia's B2 long-term issuer and senior unsecured ratings on review for downgrade. The decision to place Ethiopia's ratings on review for downgrade reflects Moody's conclusion that the government's commitment as part of its entry into the G20 Common Framework to sign a memorandum of understanding that requires it to engage with private creditors raises the risk those creditors will incur while incurring losses. According to Moody's, it is increasingly clear that in contrast to the approach taken last year under the Debt Service Suspension Initiative, official sector lenders are intent upholding the principle of comparable treatment of official and private sector lenders. And commodities market update is next after the break. Do stay with us. Welcome back. On commodities market update today, we'll be talking about tobacco. Tobacco is a plant grown for its leaves, which are dried and fermented before being put in a tobacco product. The global output of tobacco, which is at 6.7 million metric tons, has increased in spite of major restrictions in the use of tobacco-related products. Let's bring it home now to Nigeria and see how the country can increase its production. Favor Oguniraye, a research analyst at financial derivatives company, joins us now. Hello, Favor. Great to have you.
Thank you for having me.
Yeah, so Nigeria is a fringe player in tobacco production and exports. Are there prospects for Nigeria to achieve recognition as a global player, say like Kenya or Zimbabwe in sub-Saharan Africa?
Of course, there are prospects to increase tobacco production in Nigeria. I mean, that's related to, that can be, and that's the case for all commodities in general. So looking at countries like Zimbabwe and Kenya, we see that these countries are able to increase production of tobacco because of the favorable weather conditions they have. So for example, tobacco has to be cultivated in an environment where the humidity level is within the range of 70% to 75%. And that has been the case for tobacco growing zones in these countries. And also we see that tobacco companies enjoy tax holidays from government, and then they're able to reinvest that money that should have been given to the government into the production of tobacco. So based on that, that would mean that as Nigeria's tobacco industry has faced limitations because the tobacco growing zones in Nigeria are not, the humidity levels are not within that range. So that has definitely impacted the production of tobacco. And also we don't see tobacco companies enjoying tax holidays like these countries like Zimbabwe and Kenya are enjoying. So for Nigeria to increase production, that would mean that they need to invest more into that industry and also build like proper infrastructure to grow the production of tobacco.
All right, so tobacco is produced mainly in northern states because of its favorable weather conditions, and these states are also the epicenter of clashes between herdsmen and farmers. Do you think the current crisis and failure to resolve the cattle raiding problem could negatively affect the output of tobacco in Nigeria? And what should be done to incentivize tobacco producers whose businesses are negatively affected by this unrest?
The issues that are faced in these northern states, and that would be insecurity. And what has insecurity done to the agricultural industry? It has led to displacement, it has led to reduction in output, and also we see that the quality of these tobacco products have reduced. And for governments to address such insecurity issues, there needs to be a resolution of these crises between herdsmen and the farmers. So if that resolution is in place, we expect that production of any commodity will be increased. So for example, now in Ghana, we see that the government pays additional price for cocoa in addition to the global price as well. And we see that that has acted as a buffer for the production. And also, one thing government can do is to introduce tax holidays. So with tax holidays, companies are able to reinvest funds into the production, into the cultivation. They can use it to procure the right infrastructure for tobacco production. And that would definitely offset whatever negative impacts that they felt from the insecurity. Well, if you're looking at the tobacco industry in particular, we see that these crops are in plantations. So what that means is that these crops are fenced. So the problem of cattle raiding isn't necessarily a threat for the industry, but then insecurity is a threat as well. And like I said earlier, resolutions and tax holidays are things that government can introduce to increase production.
That makes sense. But a few years ago, Philip Morris, a leading company in the tobacco value chain, acquired General Foods, owners of Kraft and a major competitor to Kellogg's. What is the future of tobacco as a global commodity if the major uses of the product are diversified into foods and other related activities?
Looking at companies who, okay, so we see that companies are trying to increase their revenue base, and they mostly do that by adopting diversification strategies. And what diversification does is it diversifies your revenue, it also diversifies your risk exposure. So in terms of revenue, with such strategy, that would mean that revenue can be gotten from other products, from other commodities which are not tobacco. And that has also, and what that means for the tobacco industry is that companies might want to then invest more in those commodities if the earnings that they get are higher than what they get from tobacco. And therefore risk exposure, in cases where the demand for a commodity now, for example, if a company diversifies into a tobacco company diversifies into cassava, for example. So if the demand for tobacco reduces for different reasons, they can also get returns from their investments in cassava. So that is one of the reasons why diversification strategy is adopted. And if for that same example, if demand for cassava reduces because of different reasons, the demand for tobacco will increase, and that will definitely bring about positive impact on the industry. So the future for tobacco is dependent on, one, if the industry can be able to withstand the demand that comes with other products in this company's diversified portfolio.
All right, Favor, thank you so much for your time. Favor is a research analyst at Financial Derivatives Company. Thank you so much for joining us today. And business confidence levels in South Africa has fallen to 35 from 40 in the first quarter of 2021, below the 50 neutral mark. According to the Rand Merchant Bank and the Bureau for Economic Research, the retail sector suffered the biggest decline, falling to 37 from 50 due to lingering disappointment with Black Friday and festive sales. Manufacturing confidence declined from 31 to 25, despite exports improving. Domestic sales lost momentum, while production was hit by disruptions to supply chains. Although confidence levels are low, the index is better than the massive slip in 2020 during the lockdown. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.